I want to get your thoughts on that ISM manufacturing number today and where you fall in this debate that Mike just highlighted.
Well, it's a very important fact that this really started falling when the trade war began to escalate in the middle of last year. So the big question is, has so much damage already been done by the trade war that this is going to continue to go down? Is this driven more by if there is a change in the sentiment in the trade war? Unfortunately, at this point, when we're below 50, as Mike just mentioned, that is recession for the manufacturing sector. So we're watching very, very carefully for any signs that this is spilling over to the services sector. Manufacturing is just about 10% of GDP, 10% of employment. So broadly speaking, it's not good news, and the trend is not our friend in this data.
When you talk about watching the signs, what are the signs that you're watching most closely, and what would, I guess, change from it being just purely a manufacturing recession to one that's more broad-based?
Yeah, so it's absolutely employment. So we'll see ADP tomorrow, we'll see non-farm payrolls on Friday. That becomes very critical for any signs that this is indeed spreading out to not only being an issue in terms of manufacturing, but we're also already seeing in the data today that new export orders has been coming down, and that is a very important leading indicator also for ISM over the coming months. So that's also pointing to more slowdown, unfortunately, in the manufacturing sector here.
To what extent is monetary policy the cure?
So the problem is that if you ask how do we deal with trade policy, interest rates is not the most obvious answer. So in that sense, even lowering interest rates a little bit here a few times, there are a lot of question marks about what can that do to stem the slowdown we're seeing. So in some sense, it really is two very different forces that are set in motion here. So we're getting more and more worried about the downside risks and also the risks that the Fed may have to cut more than just a few insurance cuts.
We could talk about exports here, but compared to some of the other economies that have been showing signs of weakening and slowing, not as export-driven of an economy as, say, Germany or China. So I guess how much can U.S. growth continue, albeit at a slower pace, even if you see those markets slow even more markedly?
That's right. I mean, Germany is already at the brink of a recession. Japan has had a very sharp slowdown. China obviously has also been slowing. So the question is, with the rest of the world slowing so much, can the U.S. really stand its own? Exactly, as you say. I mean, exports are a relatively small share of GDP. So far, U.S. being a closed economy is helpful. But broadly speaking, we are worried also in the labor market data, the employment report. I will be watching on Friday for any fears that the service sector is also beginning to slow. And we're seeing some signs of that, which makes us somewhat worried about the broader economic picture.
Is there a sense that, let's say, a rollback of the tariffs and let's say some gestures between the U.S. and China of trying to work toward a deal, that it could quickly turn business sentiment enough that these things could reverse or no?
It may help in markets here, but I think the problem is that, sentiment among businesses is really the most important issue here in terms of, do they believe that this is the end of the trade war, or are they worried that maybe this will actually come back? Is this just versus China? What about the trade war with Europe and Japan? There's just a lot of issues around that specific question that maybe markets will like it in the short term, but we're a little bit worried that this is not something you just can brush aside very quickly from a business sentiment perspective.
Torsten, thanks for joining us. Great to see you.
Oh, thanks for having me.